In Investing 101, tapping into your retirement savings comes at a high price. If you withdraw that money early, there's a tax penalty, plus you lose the money you could have made if you had stayed in the market. We are turning to Jim Uren, the financial advisor at Phase 3 Advisory, to talk about how to handle a situation if you really need that money. Jim, is it ever okay to tap into that 401k or IRA?
Yes, there are a number of circumstances where you can take the money out. I mean, it's obviously always ideal if you have other sources of income, but that's not always the case for people. But the IRS recognizes that there are circumstances under which you may need to tap your money earlier than the kind of normal age, 59 and a half. And so there are a number of exceptions given. The exceptions in a 401k are pretty limited. You can take a hardship withdrawal in certain cases, but you have to kind of get permission to do so. But you can take a loan out against a 401k in many cases, and you borrow the money. That's a non-taxable event, so that's good, but you'd end up having to pay that back through paycheck deductions, and that can really limit your take-home pay. The IRA, however, gives you a lot of different exceptions where you can take money out. You'll always pay tax when you withdraw it, but you can often avoid that 10% penalty, which can save you quite a bit of cash in the long run.
What are some of your tips?
Yeah, so 4 major categories I like to think about are death, health, major life events, and early retirement. So death, obviously, if you pass away, the IRS kindly won't charge you that 10% penalty. They'll charge your heirs, of course, taxes, but they'll waive that 10% penalty. The other exception to that 10% penalty is health related. If you become permanently disabled, you're not subject to that 10% penalty. And likewise, if you have unusually high medical expenses, as long as they exceed 10% of your adjusted gross income for the year, you can pull that kind of money out of your IRA. And again, you'll pay taxes, but you'll not be subject to that 10% penalty. Now, a couple major life events that can be helpful. If you have birth or if you adopt, which is great, I'm an adoptive parent, so that's good. You can pull money out up to $5,000 penalty free. Also, first-time home buyers. If you haven't owned a home in 2 years and you purchase a new home, you can withdraw up to $10,000 without the penalty. And the other perk for major life events is education. So if you are a child, let's say, or going to school, you can pull out whatever money you need to cover the qualifying expenses penalty free. The other category then is the what I call early retirement. Any money you put in a Roth IRA, you can always pull out actually tax-free as long as you're pulling out what you put in and not any more. You can always get that out tax and penalty-free, which is good. There's also something called 72T or substantially equal periodic payments. And this is an exception that works well for early retirement. And how this works is basically you can pull money out of your IRA before 59 and a half as long as you pull out substantially equal payments. So you might have to pull out the same amount of money every year for up to 5 years or 59 and a half, whichever is longer. So this can work well if you're one of those early retirement folks and you want to start drawing on your IRA, but you don't want to have to pay that penalty. The 72T exception can be a great way to go. But with all of these, of course, consult your tax advisor because there's a lot of fine print and you want to make sure that you do everything properly so you don't get hit with that big 10% penalty.
All great information. Thank you, Jim.
Yeah, absolutely. Thank you for having me, Angie.
Go to businessfirstam.com for where to see our show on TV.